as we are winding down the first trading day of the year and looking ahead to what investors should be watching for and watching out for in the new year, let's welcome in Torsten Slok, Chief Economist at Apollo Global Management. We should mention Apollo, the parent company of Yahoo. Torsten, thanks so much for coming in. It's such a pleasure to see you. What a great way for us to start the show in this new year. I'm going to start, though, on a bit of a more downbeat note, because there is a decent amount of optimism this year. But what do people need to be worried about? What are the risks heading into 2024?
I think there are two key risks this year. First of all, as you just talked about, last year's gains were really concentrated on a handful of stocks. So I think that looking at the market today, we need to think about, if I take a fresh $100 and put to work, what am I actually investing in? Am I buying the AI story, as Josh was saying? Or am I buying in the 493 stocks that were not the AI story? What is the view that I'm expressing if I do decide to buy the S&P 500 today? So I think that the really unusual driven higher in stocks by a very, very small handful of names was so unusual that we need to think about that as where we sit today. So first of all, the concentration in the rally yesterday is very critical for anyone who thinks about markets at the moment. The second thing, which I think is a much broader topic, is this issue: is the Fed really done fighting inflation? The problem was that the Fed pivot has been interpreted by market as all problems are solved. COVID is solved, inflation is solved, nothing to worry about, excuse me, hooray, hooray, everything is fine. But now you look at it today, is that really what they said? Several FOMC members afterwards have come out and said that's not quite what we said. And at the same time, this rally in the market is probably going to result in a boom in housing, in the labor market, in consumer services, in consumer goods, in travel, in airlines, hotels, restaurants. All that combined means that maybe the Fed swung the pendulum too much in the dovish direction. And therefore, if the Fed now needs to pull that back more and say we're not quite done fighting inflation, you have overinterpreted what we did in December, I do think that markets will have a more bumpy road ahead, where equities will begin, in particular, but also credit, will begin to look at, well, maybe the Fed is not quite done when core CPI today is still at 4% and their target is to be 2%. So we're just not there yet, because 4 is not 2, and therefore we're just not yet can declare victory over inflation.
And Torsten, so that's exactly right. So the Fed chief, Jay Powell, last time he spoke, you're right. I mean, markets reacted. It was time to party. We saw the rally in stocks and bonds. What is your expectation, though, then, Torsten, given all these kind of puts and takes next year? When do you think the Fed cuts, and by how much?
Yeah, I think that the Fed will start cutting rates later than what the market is pricing. At the moment, the market is pricing that the Fed will cut 6 times this year. The Fed themselves say we will only cut 3 times. So there's a quite wide divergence between what they are saying and what the market is pricing. But what I think is most important is exactly to your question, Josh, that if inflation is at risk of not coming down so quickly, and if we now are on top of that at risk of the Fed turning their message around, might actually be lifting inflation over the next several quarters, well, then I do think that the Fed's communication is going to be very similar to what they had in 2022, namely, we're not done yet, we're not done yet. And if that's the case, we in markets should also be looking at things from, well, if they're not done yet, that perspective means maybe we should also be still a bit cautious on the upside to equities.
There are also some other risks that have been discussed for a while out in the market. And I think of credit in particular, right? I think of commercial real estate as well, and the risks that people think it might have for bank balance sheets. Those have kind of been floating around out there, and they haven't yet come to roost. Is that something that people should be watching this year?
Yeah, this is also very important. 70% of all commercial real estate loans in the banking sector are on small banks' balance sheets. And banks here in this definition is banks number 1 to 25 are large banks in the Fed data. Bank number 26 to 5,000 are small banks. So bank number 26 to 5,000, they have about 70% of all commercial real estate loans in the banking sector outstanding. So that means that a lot of the risks, in particular to commercial real estate, are on the books of the regional and the smaller banks. And with the office prices in the US down now 40%, that of course means that a lot of those loans to commercial real estate that need to be refinanced. Remember, a commercial real estate loan is a 30-year asset, but it's financed with a 5-year loan. So a 5-year loan that suddenly is refinanced at a much higher level of interest rates. Let's say you did a loan in 2018, you wake up in 2023 on next year, 2024, 2025, and you suddenly have to refinance that loan at a higher interest rate. Not only do you need to then pay up more to refinance it, but you also have to pay the equity because the value of the underlying asset is down 30-40%. So that's why there's a lot of headwinds still to commercial real estate as at least another risk. And as you also mentioned, other risk when it comes to credit is that we've had a very significant rally in lower rated credit, in loans and in triple Cs, the lower end of quality of high yield. All that also looks a little bit premature when you think about the risk that the cost of capital is going to stay higher. So I would say, summarizing our conversation here, I think that the main risk is that we are underestimating page 1 in the finance textbook, where it says that when the cost of capital goes up, it does have a lot of consequences both for credit and for equities.
I'm interested, Torsten, another key thing we have to think about here is the consumer, who's proven remarkably resilient. And they have that labor market is sturdy. As you look ahead now, Torsten, what do you see for the consumer? Because some folks say, listen, on the one hand, they see a labor market that's cooling. It's not crashing, but cooling. They talk about dwindling savings. On the other hand, also resumption of student loan payments. Exactly. How do you add all that up? Where are we with the consumer?
Well, I think that there are three factors impacting consumers at the moment. The first one is that consumers had a lot of excess savings after the pandemic. It just happened to be the case that consumers saved a lot of money after the pandemic because of stimulus checks, unemployment benefits, and because also we were not traveling, we're not going to restaurants, we're not staying in hotels, not flying on airplanes. That meant that households by late 2021 had about $2 trillion in excess savings that they would otherwise not have had. And running down those savings have taken quite some time. And that's what we're getting to the tail end of that. There's a lot of Fed papers that are showing we're getting to the end of that consumption boom that we have had as a result of these excess savings. So that tailwind is running out of steam over the next several quarters. Exactly as you're saying. Secondly, student loan payments have restarted on October the 1st. That created some headwind to consumption, in particular in October, but that's also a key risk looking ahead. The third and final issue impacting consumers is that now, if we have mortgage rates coming down because of the Fed pivot, if we have auto loan interest rates coming down because of the Fed pivot, if we generally have interest rates moving lower, that could actually provide a boost to consumption. So we have a little bit of a mixed forces with the tailwind coming from households running out of excess savings and student loans restarting. But at the same time, because of the Fed deciding to turn more dovish and the market interpreting that in a more dovish way, that's now becoming a bit more of a tailwind. So we don't anticipate that this will create a sharp slowdown, but it is very critical that excess savings running out will begin to probably give a path for consumption where we are going to see a slower growth rate over the next several quarters. So that should be a softer landing for the US economy overall.
What's going to happen with wages on the other hand?
Yeah, the labor market, as Josh also just mentioned, has been very, very strong. And I know you've covered this very well, of course, on the show for quite some time, that if the labor market is so strong, well, then consumption of all types of retail goods, discretionary, staples, should be also very strong. So far, the labor market has remained incredibly resilient because firms have been very reluctant to fire workers, and therefore labor hoarding. They've been holding on to workers to make sure that they didn't get into a situation where they didn't have enough workers. So therefore, we should expect to see on non-farm payrolls on Friday, we probably get that closer to 180,000. That still should be something that should be consumption supportive, at least for quite some time. So again, very consistent with a general slowdown, not a hard landing, not a no landing, but a soft landing, which again means that the Fed is probably not quite done because inflation is still at risk of having this tailwind from the economy still doing okay.
So to wrap it up, something that we're asking people is sort of New Year's resolutions for investors going into 2024. What would you say to that?
I would say coming out of last year, what you two just discussed, I mean, this issue of, we should all be, of course, happy when we get higher returns in our portfolios. But the composition of these returns really matter. Were I diversified enough in my investments? Did I only have essentially an AI story that created incredible returns last year? I mean, incredible by so many metrics, because if you look at the returns and the concentration, there's just so many things that are just out of whack relative to where this was historically. So I would say, look at your portfolio and think about, am I willing to buy into the AI story again? I know today the market is disagreeing with that, but I do think that thinking hard about, am I diversified enough in my investments? Am I just essentially investing in the AI? Am I enough in credit, in alternatives, in other asset classes that can try to spread out my risk so that, yes, great, let's say I had the S&P for all the last 365 days. It's good, I had some nice returns, but now it's probably the time to begin to think about, do I want to be exposed to the same type of risk given what the rally was and how strong the gains were in a very, very small group of stocks? The S&P 493 were essentially flat last year. That tells you that there's a lot more homework now to be done in thinking about what are the other opportunities, how can I make sure that I'm not only exposed to those 7 stocks that have driven returns so much.
Torsten, a very smart New Year's resolution for our viewers.
Thank you.
Thank you so much for your time and insight. Appreciate it.
Appreciate it.